and Asia. I actually have someone from Thailand. We got them all over the world. So great to have you here. So the question that we're going to kind of approach today is, what do we do with trades that are longer term as we approach specific events, specific times, profit loss levels? Let's go through these scenarios, and I've got this set up right here. So let me share this with you. And this Forever Friday, I like to look at long-term strategies on Forever Friday. So today we're going to manage the long-term positions that have options, or manage long-term stock positions with options. And this is going to be some of the ways we can manage our deep current stuff. It's going to be how we can manage your positions that maybe you've held for months and years, or you're going into something and not knowing what to do. I actually had a question on Micron, and we can use that as an example here in a minute. The way I look at this is, when we're setting up and managing a long-term position, I want you to kind of have 4 main things that we use to manage. If it's doing what it's supposed to do, or if it's moving towards our target or not moving against us, there's not a lot of reason to do anything unless you have one of these things. I'm going to say there's price-based management, there's time-based management, there's event-based management, and there's profit and loss-based. Now, you might think that price-based and profit and loss-based is the same. It is not. We're going to walk through a couple of things that I would look for. And again, we will take some time on the event-based to talk about Micron to answer that question that I got in the email. So as we're looking at this, when to manage, let's start with the price-based. And this may be disturbing to some of your egos. Maybe it's not, but it could be. So when we're looking at the price, or the price-based, I want you to understand very upfront, the market does not care about you. That's not a bad thing. It's not a person. And even if it were a person, do you really care? The market really does not care about where you got into your trade, where you got out of your trade. It doesn't care about how you set up your trade. It cares about what price levels it has determined are barriers. So as we're watching these, we're looking at the highs, the lows, the moves, the supports, the resistance, what I call supply and demand zones on my chart, the way I do that. If we're looking at these areas, that's where the market cares, right? And good day, mate. So we got some Australians here as well. Hello, Trains. Shell, good morning, Raj. Maori. I'm hoping it means hello, Blake, rather than just saying hell, Blake. I hope you're not condemning me to the pits and fiery torment. Hey, Joyce from Spain. Good afternoon. Blake, Europe. Hello. Hello, my friend. Are you in Portugal today? Good morning again, JT. Got your day done. Shorting the high of a range 3x2. Nice. Stefan or Stephen or Stephan. Not sure which pronunciation, but yes. Kristen, the market doesn't care about your needs, doesn't care about your wants, doesn't care where you got into trade, does not care. It has no feelings. It doesn't care. It cares about price action. So we're going to walk through Stefan. Okay, I will try to remember that. I will try to remember that, Stefan. But good to have you here. There's a lot of ways to pronounce it. I don't know, Stefan. So market doesn't care where you got in, doesn't care what you're doing, doesn't care why you're there. So don't manage your trade based off break even. Don't manage your trade based off what you're willing to lose. You've got to let the chart tell you where to put your risk, how to do that, and then manage that accordingly. We'll get to the profit loss adjustments later, okay? So the market just doesn't care where you got in. And if there's a stock that you want to look at, I will look at it with you, and we'll look at it with fresh eyes. We'll approach it with the idea of who cares where you got in and what's it telling us now, okay? And we'll look at some long-term charts. I'm going to go through all 4 of these really quickly, and then we're going to go back and give it specific examples. So Stephen is Stephen, Stefan is Stefan, Kristen is Kristen. All right, we got all the names. Yeah, and we'll look at Mara for sure. Okay, time-based. If you're in an option trade, now this is time-based, meaning look at a calendar. This is not time-based event, that's next. This is time-based as far as a calendar. If you're in an option trade and you have long and short positions, we have long positions that we own, we have the rights to. We have short positions that we have obligations. So we're going to roll shorts or close them completely anytime those shorts, or what I call the obligation side, gets to 3 to 10 days before expiration. Now, you might say, well, that's a pretty big window, Blake. That's an entire 7 trading days, or 7 days between the 3 and 10. How do you decide? Really simple. If it moves against me starting day 10, it's time to roll or get out. If it keeps moving in the direction of my trade, I wait. So at day 10, let's say it's bullish and I have a short put, okay? At day 10, great. At day 9, it's still moving up, great. At day 8, it suddenly closes down, exit. So in the 3 to 10 day time window, any short position, any obligation, I'm looking at that as an indication to roll or close if it moves against me in that 3 to 10 day time window, because the remaining time decay that we're benefiting from is not enough. Now, if that's a vertical, same rules. If I'm in a vertical, both the long and a short, because I have that short and that obligation side, when I get to the last 10 days, I simply say, is it going against me? Did price close down in a bullish trade or close up in a bearish trade? Does that make sense? What we're looking at. We'll show you some examples here in a minute. If it's just a long position alone, I want to roll it if I get to about 2 weeks before expiration, because I'm generally trying to play a trend. I want that trend to give me enough time to reach its targets. And so if I get to about 2 weeks, 15 days, so half a month, I want to roll that out to more than 3 weeks. I generally want to go almost 4 weeks. It depends on the chart and whether we're doing channels or whether we're doing other setups. But we want to roll that when we get to about 2 weeks out. So it's a little bit longer than this, but we're going to roll that just because we want our time decay to slow down again on stuff we own. The next one's not the last one. Next one is event-based. And this is when I want you to consider hedging or closing ahead of a dividend, an earnings, or a major economic event. And we'll come back and like I said, we'll look at Micron in this one too. If they're a dividend, it changes how I hedge. If there's just earnings, then that's a different hedge. So earnings and dividends, we take that very different approach. And at every major economic event, like Fed Day. So how do we protect our trades and move those through? We'll go through and go examples. And then the profit and loss, if I hit specific profit and loss targets, if I'm in defined risk trades or just short trades, so short put or naked put, or a short call, naked call as well. If I hit specific profit loss goals, I'm going to close those. If I see a specific loss on a long position, that is still going to be something, hey, I've risked this much. And generally speaking, I use half of a long call or half of a long put from the initial entry. So let's go through each one of these step by step. And let's take a look at Mara from the price, because I asked the question and then the Mara was thrown in there as a price comment, right? Specific to reviewing price. So if we're in Mara, I don't care where you got in. I really don't. It's, it is what it is. That's all what we can do with it. Whether price is good or bad, it does not matter. I will go look at bonds here in just a minute as well. But if you're in this trade, all I care about is what's it telling me now. It doesn't matter where I got in. If you got in and bought in all the way up here and bought in at the peak, you went long. I don't care if you've lost this money as far as managing it. I do care that you lost money, but I don't care that you lost money if we're going to manage the trade. I care about where is it at now and where do I know it's bearish? Where do I know it's bullish? So you'll hear me say, where do I know I'm wrong? If we're looking at price and this current chart, and we can look at other indicators like divergence, other things, all I care about is if I'm in the trade right here, I'm going to ask the question both sides of the equation. If I am bullish, if I'm expecting this to go up, where do I know I'm wrong? Where do I know it's bearish? That's really what the question is. If you are not in this trade and you're looking at this, where do you know you're bearish? Anyone? Give me a number. Forget whether you're in the trade. Where would you be willing to take a bearish trade in Mara Holdings? That's what I want you to determine. So if we know where that is, if we say, well, and this is a 1 standard deviation, it's one of my trading techniques. Don't worry about that either. We're just looking at price. $16.24. I like it. You can use that middle moving average. So if you're using a 20-day moving average here, that's what this is. It's 20-day Bollinger Band with a single deviation. So 20-day moving average. If you say, I need to get through that 20-day moving average and I'd be bearish, that's the level that either you're staying in the trade and hedging, managing, adjusting, trading positions, or that's the place you go short. The market doesn't care where you got in. Doesn't care if you got in at 2150 or if you bought the low perfectly. If you say, I'd be willing to go short at 1624, that's the place that you start hedging or getting short. If you're trying to hold on to the position for a longer time period because you just want to hedge out the risk, that's where you want to hedge. Now, we could also say a break below the lows, but now let's take the opposite side. I'm going to use Bertram's 1624 for a minute, where if that's where we could go bearish. If you're in this trade, what would it take for you to go bullish? If you're not in this trade and you're saying, so I just said, where do we go bearish? Where would you feel like it's bearish? If you shorted this position here and say, I shorted right today at 1864, I shorted this thing. I don't know why, but I did. And I shorted right here. Where would you know you are wrong? Where would you say, I need to go bullish now? I cannot not take this trade short. In fact, I need to take it long because I am completely and totally wrong at this point. Where would you know that you could step in as a breakout trade, like a Gianni type trade, a bullish trade? Where would you know price-wise that it's time to get bullish? It's time to get long on this chart. And I'm not saying a pullback and a bounce. I'm saying you shorted today. Where do you know you are wrong? That calling the top today, maybe you sold because you saw that long shadow. Is it the long shadow? Is it up here? Is it up here? Is it up here? Okay. This is audience participation, by the way. This is where you can type in numbers. Maybe you don't know. If you don't know, then you don't have a target. If you don't know, if you took a short position here and you say, I don't know where I know I'm wrong, then you should never take those trades. Everything is bullish all the time, just buy, buy, buy. Okay. So if you shorted because of this, then probably the top of that candle, because you have a gap, you have the top of the candle, you have a gap up, gap down. So either the top of this candle at 1923 or 2004. So fill the gap here all the way up to 2004, 1990, 2004. We'll say $20 even. Okay. These are the areas when we're looking at this, regardless of where you got in, regardless of whether you're bullish, regardless if you're bearish, ask yourself the question, if I were short or bearish, where would I go long? If I'm long or bullish, where would I go short? If you can define those, you're going to define how to manage your trade. Whether you're talking about stop losses, whether we're talking about adding options to it, whether we're selling calls against it. And my rule here is if I figured out, okay, I know that if it gets up here, right there, then I'd be willing to go bullish. So this is the point where we don't sell calls until we're up here or higher. So if we test and fail there, what a great time to sell a call. If we go up and touch that level and then fade. But there's no reason to get out. We'd want to collect premium, move stops, etc. if we know that's the area. So at this point, if I were short, I'd get bullish here, fill the gap and go higher. Great. That's going to tell me how to manage my bullish trade. It's also going to tell me how to protect my bullish trade. And the opposite would be great. If I went short, I'd protect it here and manage it here. So all I'm doing is flipping it. Where I decide it's time to go bullish or time to go bearish, then I have levels that say, if we're going to go bullish, if we're going to go bearish, these are the areas I'm going to manage, sell premium, and protect. And it does not matter where I got in. If you are moving your stops to break even, what you're doing is taking a system that has some profitability, likely, and you're putting most of your trades to break even, most of your profitable trades, because if they didn't move in your favor anyway, then they were going to be losers. So how many of your losing trades went in your favor and then went back to break even versus how many of your trades went profitable and then pulled back to retest? We don't want to exit solely based on those situations. We want to be protecting our trades and moving them along, okay? So we want to get down to price. Now, someone was talking about Apple just a second ago, so as we're looking at Apple, here's a great example. If I'm an Apple and we're bullish, I want to determine where I would know I was wrong. So anywhere through here, we know that if we got through these lows, we've reversed the trend. That would keep us out of exiting or avoiding exiting on this pullback. If we're creating higher highs, higher lows, higher highs, higher lows, in Apple, and we'll deal with this right here. If we're bullish through Apple, we're making higher highs and higher lows. And again, ignore my indicators. We're just dealing with price alone. So let's get rid of that. Get rid of that. Okay. Price alone. If we're creating higher highs and higher lows, if I know that I'm in this long-term trend and we're up here, regardless if I got in here or if I got in here, and the pullback and it starts to climb, no matter where I got in, this becomes a potential area to protect. In fact, I would say as soon as you make a new high right there, then you can trust your low. Until you make that new high, you don't have a full set of higher highs and higher lows. So price-based action is one of the most important things. We're taking a little bit extra time on it today with this part because we have about 25 minutes. We're going to cover the rest. So as we look at this, I would say you're in that trade, whether you got in all the way at the lows or here or here or here, it doesn't matter. And when you see 2 days go against you, that's where I want to sell calls. If I own the stock, I want to sell calls when I see 2 days go against me. And I want to sell about 2 to 3 weeks worth. So as it pulls back, my short call is profiting. And we'll talk about the profit loss on just the short side when we get to profit loss number 4 of what we're talking about. And I'm protecting here because I know I'm wrong here. The long stock's just doing its job. The short call's paying me on the pullback. When I bounce and go back up, hopefully the short call I've completely protected and taken off the table. Okay, the short call hopefully is completely paid for and I have free money. And then when it bounces back up, that bounce, that higher low through here, as soon as we make a higher high, I know I can trust this low. And I know I have a full set of higher highs and higher lows. Any hedges that I put on there, including the short calls, should be off as we're moving back up. And so I'm collecting that premium, offsetting it, and as we break free, if I know that if I were short, this is where I want to be bullish, I'm not hedged here. I'm bullish. I'm looking at that as a breakout. So whether I got into the trade or not, this breakout is saying stay with the trade, let it run. There's no need to hedge. We're running, we're letting it trade. Price rules. In the end, price rules. Let's look at MU as we talk about earnings. Okay. Who is, I forgot the name. Who is my MU person that was asking this? It was soap poisoning. Craig, are you here today? Let me know if you're here. All right, so here we have a stock that is super bullish. Now notice we have a dividend. It has not been announced. It has not been declared. So as we're looking at this, first off, we got to go with price. So we're going to manage at price. We know that price is key. We need to find out where I know I'm wrong. Okay, so if we're in this trade, and again, I don't care whether you bought in at $61 or you bought in yesterday at the worst price possible at the peak, and then today you woke up to this gap down. We have earnings on 9/23 after market. So really we have all the way till next week. As we're looking at this, pulling back through here and finding that support level, regardless of where you got in, you cannot manage based off of anything other than what the chart says. We're in the trade. If you're in the trade, whether you're profitable or lost, this is where we manage. So what do we know? We know that we're in this trade. We have a higher high, higher low. So I'm going to ask the same question I've asked already. Start with price. Where do you know you're wrong? Let's start with that. Because if I know I'm wrong, if it goes past a certain point, even on earnings, if it gaps past, trades past a certain level, I want to protect that. But I still want to know where I'm wrong because I want to be able to manage to that level. Where would you go short? That's really the question, Craig. A lower low? So are we talking about all the way down here? What are you going to call your lower low? TBCCRN? See, if you think it's hard to pronounce Stefan, how about there's no vowels in there at all. What do you think? Tricky. 50% pullback, maybe this low, maybe this gap fill. This gap has been tested right there. Pulled back to the gap. I'd say if it closes below 150, we should be done. a close below 150 or a trade below here, because then we're doing the next gap. So either a close below 150 or down through here at 146, I would want to be considering shorts. Yeah, so gap fill, close below 140 for sure. But I would even look at maybe a close below 150, because then you're going through this gap. And that's a $12 drop. So just giving us some numbers of where we might want to hedge. So let's go take a look at the options really quickly. We know we have earnings through here. Number one, if we know we have earnings and we know we have this dividend payment, the dividend payment's 11 cents. It's not worth trading for the dividend. If the dividend is higher, then it probably is, but this one is not. This one's not going to pay us enough to be worth taking extra risk. So if we're going to look at this, let's take a look at the options. We have the 23rd. So the 26th is going to be your highest implied volatility, and it's going to be past earnings. If we're going to hedge, we don't want to be paying for that. So the question that was asked in the email was, what about a calendar? What about some other trades? If we know that this would be the case, I know I'm wrong here, then the opposite side would be true. Where would you know that you could stay bullish? Are you going to need a new high, a new breakout, a new move? Because right now we're just talking purely about price action. I'm not saying that I don't use all those other indicators. I'm just trying to keep it clean right now. So yes, I use stochastic divergences all the time, but does a divergence play out when we have earnings like this? Go back and look. Bearish divergence right into earnings, and it barely drifted lower. It really didn't move for 2-3 weeks. So the last time we had a bearish divergence at the last earnings, it didn't do anything. See that? So I'm not sure I'd want to chase that down, but right now I'm just dealing with as clean and simple an approach as we can do on this chart. So if I know that I'm looking for getting short or bearish at 150, I want to manage down there. And if it gets through the high, I want to stay in here. I've got a 150 to 170. So if it breaks higher, it could go $20. I could go up to 190. I could go up to 200, but if it clears 170, I want to be staying in there. What if I sold calls up here to fund puts down here and create not a collar, but what we call a married put? So this is the approach we take. And we can do the married put or a short call and a calendar too. But let me just show you what the math looks like. So this is event driven, and we still have some time. You could do this Monday, or if you didn't want to do it today. This is math driven. So if we know that we could move up, notice the market makers are pricing in $17. I just said 20. Interesting. So if we're looking at that $20 higher, 162, that'd be 182. We could collect 185 going out 22.50. We could even collect almost $2 for 190, well above the next level. And if I'm in the trade, and ask yourself this question, Craig, if you're in the trade, I don't care from where you're at. We're talking about from right now at 163. Would you be okay with taking another $17 profit? Oh, sorry, not $17, $27 profit and being forced out, even if it goes up to 190. I think that's a pretty good deal to make, what is that, 18% more on the next move. I'd take that. So we can sell the 190 and start protecting your trade, and then use that premium from the 190 or the 185. I think 185 is fine, but I'd probably go with the 190 because the little bit of extra premium for the probability of getting called out, you can let it go to 185. So if it goes up to 185 or 190, then I'm gonna get another $2. We're just gonna use $2 to keep my numbers nice and round, okay? At that point, I'm collecting $2 premium here, and we're going to pay less to get us past that next dividend. Now, keep in mind, we're gonna get 11 cents. It's not a lot, but normally earnings to dividends, we're talking about 2 weeks. So if I went 2 weeks further, boom, boom, notice I'm paying a lot less implied volatility. I could protect this down to where? 150. I already knew that's where I'd want to go. So if I got paid $2 and I have the protection down here at 450, I'm now really only paying $2.50 to protect it down to that point where if it gets through there, I know I'm wrong and it's going to free fall. I'm getting paid $2. I pay $4.50. I'm protected at $2.50, and it could fall, and it's only a $12 drop here versus looking for a $20 gain here, and it allows me to protect my trade. There's more, because we can still sell the 150 on this front week, because we already know it's pricing in about a $12 move. So we could do a calendar at the short put because we know we're getting overpaid, and I can get paid $289. If it doesn't go through the 150, and vol crush is going to happen because this is earnings are afternoon of the 23rd, we have 2 extra days to be able to play this. This is going to crush out. And that means this is going to crush out, and I'm still going to own the 150. So if I collect $2 and I collect $289 on the short 150 and short 190, and then I own the 150 for $425, I actually get a small premium here. And I created a weird, it's not a collar because it's not that same expiration. I'm doing a longer put to protect my trade. So in essence, I'm bracketing this down, saying stay in the trade if you want, and we're going to get $489 plus my 11-cent dividend. Woohoo! So I'm at $5, and I've collected $5, and I've paid for my insurance. That's the whole point. I'm not trying to make money on these positions. I'm hedging and protecting. And so I've paid for my insurance because I got paid $5 on dividends, short puts, short calls, and then I own the 150 for $4.50. So I still have 50 cents. I'm not worried about that 50 cents. I'm protected, and I'm protected out 3 weeks, long past the earnings. Does that make sense? But it's a matter of still going back to price and say, where do I know I'm wrong? How much premium can I get? Can I get enough premium here to pay for the other? And that's going to be more of your event-driven times. When dividends are high, then oftentimes your dividend will pay for a put 2 weeks further out. And so you can actually protect your trade and be in the trade and protect it while getting paid a little bit of premium that will pay off your long put. And that's the cool thing about the chart and the risk is you're protecting based off that. Does anybody have a dividend stock that's coming up soon? We can do that one here next too. If anyone knows of a dividend stock that you're waiting for a big dividend or a relatively big dividend, how you'd approach that. And we could look at the utility stocks, but a bunch of those are just passed. I was saying the 120, the 190 call or the 185 call. So if you own the stock, I'd say the 185 call or 190 call. Collect that $2-ish. Then do the 150. So we're protecting a lot tighter. We're letting it have the room to keep on going. The trend's already been up. We're protecting tighter on the downside. We're giving it room to move on the upside. Nearly twice the amount on the upside. And it pays for the whole thing. ABBV for dividend. Okay, let me do that one really quickly. We'll get to the other. If we don't get through everything today, we'll just use this next week too. So ABBV, when's the dividend? Ex-dividend date for ABBV is 10/15. Now, dividends is $1.64. 10/15 is out still a little bit, but we could hold this through here. Notice, if you know you're getting paid $1.64, and we'd want to go closer and closer and closer to expiration, but right through here, if we were the week of, and if everything stays the same, notice that your dividend is going to pay for your at the money put. If you're trying to collect those dividends, great, totally understand. But as you approach that, you could also sell the call and collar it and buy the put. The call will pay for the put, and the dividends, you can hold the stock. Unless it goes up and calls you away, which, by the way, they will never, ever, ever call you away unless your call is in the money, what is the equivalent of the put. Now, this is, if Todd's listening, this is from Todd. Todd gave me this awesome information. Here's how you know if a market maker, from someone that was a market maker, worked the floor, if they're going to call you away on your calls. If you have a short call and you're going into a dividend event, if the dividend is paying you $1.64, don't worry about what your call's worth. Worry about what the put is worth. So what it's telling you is if the put costs less than the dividend is going to pay, everything on the call side that's in the money there are going to be called away early, usually. So your dividend risk on calls or anything where the put's in the money of that dividend. Now, this is not ideal. If we're dealing with this today, and this is not going to be the greatest example either, but if we're dealing with the dividend today, you can see the 222.50 is only 61 cents. So what people will do is they will exercise their rights on the calls. They will exercise those and buy a put, because they'll exercise, own the stock at 222.50. They'll pay 65 cents for that put. They own it 222.50. They paid that. They end up, it's free money. If they own it at 225, they're going to exercise that. They can buy the put and protect it. They get a free dollar. If they own the stock here, sold here, and got that dividend, it's a free dollar. So look at where the puts are worth less than the dividend, and anything that's in the money on the calls that way, everything that's less is going to be exercised. So Daniel, we'll have to do doc later on. If you want to remind me, this is going to be 10 cents. It's not enough, number one. It's not a big enough dividend that would be worth hedging out that until you get a lot closer. All right, let me cover the last two things at a very high level really quickly. We have 12 minutes, then we can go through as many of these symbols as we can, including on XLF and other things like that. We're going to tie all the pieces together. Okay, 17 cents. Yeah, so you're not going to, if you're dealing with a dividend on 623, that means maybe 923. If we're getting the same 923, you can look 17 cents. The 53s, 52s, and lower are all going to be called away on the calls. But even the ones that are in the money aren't going to be called away ahead of time until that hedge is free money. So October 27th, you have to go out here. Yeah. So the 53, 52, 51, all of those will be called away likely before expiration or ex-dividend date. All right. I'll try to get through all those KKTC as well if we can. But I do want to highlight a couple of other things that we're talking about here when we're talking about these. We talked about the price-based, time-based, events-based. Profit-loss-based is really going to come down to fixed risk trade. Now, really, we could say fixed risk, fixed reward, defined risk. It's not just those are fixed risk. It's fixed risk and fixed reward. So verticals or just a long call or long put. Remember, if you're just in a long call or long put, you have a time-based threat because you're slowly losing time decay. You have a value-based threat because you're slowly losing time decay. If you're buying into these and you lose more than half the trade, I combine the profit loss with my targets and my max risk and time. So if you have a time expectation, my rule is going to be if it doesn't reach half your target and half the time you bought, start looking for an exit. If your defined risk trade, long call, long put, loses more than half, start considering an exit. Everything that's a vertical has defined risk targets and stops, not diagonals, because even though they're defined risk, we have the opportunity to roll again on the short side. But any vertical that has a defined risk and a defined target, anytime you can get 85 to 90%, 85 to 90% of your max gain, there's no reason to hang on. And let me explain really quickly why, and then we'll get to some of these examples in the last 10 minutes. Let's say we buy let's sell a put. We'll sell a put vertical or sell a call vertical, it doesn't really matter which side. And let's say we get, as often as the case, sell it out of the money delta. We collect 35 cents and we have 65 cents risk. 35-cent credit. This could move all the way to your target. It could move so far out of the money that this trade is all the way up to the top. The most you can make on this is 35 cents. So when you can get out of this trade for between 3.5, that's your 90%, and 5 cents, that's your 85%. If you can get out for 5 cents, why would you hang on? And let me explain why this is not going to work this way. Why would you hang on? I've seen the same thing with just short puts. You got paid $1 and it's at, or maybe even got paid $2 because we like to use that 2.5%. And you are at the point where it's got 30 cents left in it. If we look at these, and we'll use the SPY for this example, if we look at these and I did a short put or a short put vertical and we have 85, 90% of the most we can get, watch what happens to your probabilities. We'll come back and we can do the XLF too. As we're looking at this, we're looking at SPY, no matter where we got in, let's say we sold a put back here. Sorry, sold a put back here. And I like to sell 3 weeks worth, generally speaking. So if we're selling a put and we sold it at a delta of 42, 40. Well, let's go here. Let's delta of 40. And we'll assume everything is the same. It's not, because we have some things coming up. But everything is the same. We're going to assume that I sold a 659 for 580. Okay, 580 for 659. 3 weeks out, and now we're coming to the last week. So I won't even do today. Today's even more egregious. But pay attention to a couple of things. We're selling a delta of 40. So we have a 60% probability of keeping the short put. I'm collecting 580, which is not even 1%, but 580. If we had that trade and it's gone up to 662, if everything else is the same, if we look at 1 week out, oops, undo. We look at 1 week out and we look at, what did I say? We look at 659, right? 659. So if we look at the 659, it's worth 250. We have 1 week left. It's gone up. It's moved out of the money. And if you look, our probability has only gone down by 5%. So we've collected half of it, and it's only gone down by 5%. If we're holding this into today, so the time decay has worked on the other one. Look at this. Oops, wrong one. 1 day, 0 days. The 659 here has 10 cents. And you might be saying, but that's the trade. I'm going to go ahead and trade it here, and I'm not going to exit and let it expire. What's the probability of getting in trouble today? If we collected 580 and it's worth 10 cents today, according to the delta, what's the probability of it reversing? I have a 90% chance of it not happening, but I have a 10% chance of giving up. But here's the thing. If I sold it for 580 and I can get out for, we'll say 15 cents, okay? That means I have $565 per contract of profit. And again, the market doesn't care where you got in. Don't think of it like this. Don't think of it like I've got $565 profit. I'm just going to get 15 more cents. I need you to think of it the opposite direction. And that is, would you risk? Yeah, it is very low. But here, let me ask you the question, Jaguar. Would you risk assignment for 15 cents? Would you sell this put today? Jayhawk, I don't have time to go through the results because I've got 5 minutes. I will be posting the updated spreadsheets today. I will send out an email with today's results and the updated spreadsheets for the entire month of August and this week up to Friday. If you wouldn't sell a put here, if you wouldn't say, I want to collect $15 with a 90% probability, that tells you shouldn't do it. Why on earth would you risk $565 to make 15? That's what you're saying. By staying in the trade and not exiting, you're saying I'm going to risk $565 to get 15. Or I'm going to get a sign at 659 for 15 cents. Even though it's a 90% probability, if you would not take that trade, then it's time to get out. And you know what I look for? I always look for an edge. So when we run the numbers on any of these numbers, if we say I've got a spread and it's paying me 35 cents and I'm risking 65 cents, I already know I need to be right at least 65% of the time. The probability, this is your reward risk, and I got to wrap it up here in just a second. If your reward risk ratio says you need to be right 65% of the time and your probability is at 65%, that's pot odds, it's balanced. If you're in that trade and I say, or I'm setting up the trade, anytime I can get 3 to 5% edge, I'm interested in trading those. Okay, that's the edge. So the opposite is true as well. If the edge goes against me more than 3 to 5%, it is time to get out or roll or leave. If you never would take if you would not sell a short put, $15 short put, even with a 90% probability here, then you should not be in that trade. Is there possibility that we could drop $3? Sure, we saw it yesterday. We could see expiration Friday go crazy and we could see a sudden last of the market sell-off. If that's the case, this is not the time to be in the trade. Now, if we're talking about out 3 to 4 days, that's when I'm really getting done. Remember my time rule, 3 days. I want to be closed out in 3 days. Look at the 3 days at 659. There's still 70 cents in there. There's still 70 cents. So if we talked about that 585, would you collect 70 cents and risk 515 if you had a 23% probability of failure or a 77% chance of success? Well, we can run the numbers. Let's run the numbers and determine if there's an edge here, if it's time to exit. So we take we already know it's 585. Our risk is 515 divided by the 585. We have to be right 88.03% of the time. This says we're going to be right 76% of the time. The edge has moved against us to a negative 12% edge to sell that premium. It's time to get out. Does that make sense? Does it help? Does it make clearer ways of managing these long-term exits? Again, I want you to go back and look at this. The market doesn't care about you, doesn't care about where you got in, doesn't care about where your position is. From right now, you don't get to control what's happened in the past. My comment is always, 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 always that in the end, I hate when people talk about I'm playing with the market's money. The market doesn't care where you got in. It's not the market's money. If you can push a button and close it, it's your money. You've just left it in the market. That's your money. That profit's your money. Whatever loss is already experienced. Where you're at right now is yours. So every time you're managing long-term positions, look at price, assuming you're not in the trade. Look at time. How much time do you have on any options? Look at the events coming up. Can I hedge it and protect it? And then pay attention to your defined risk trades and make sure you're looking at your profit and loss. If you are in anything that is a short position or a vertical that you have a max gain, then look at that and say, whenever I can get 85 to 90%, I need to get out of this, because at that point, your odds will skew against you by 5, 10, 15%, and it's not worth the trade anymore. Tony's in the house. He will take you through the next time frame. I'll be updating some spreadsheets. I'm going to be doing some writing. I'm going to finish writing it and responding to some emails. But I'm going to let Tony take it from here. You are the host, Tony.
I'm
You
the
can take it.
host.
You are
Sweet.
already.
Look at you,
Amazing.
Johnny on the spot.
Oh, I didn't do it. Someone else
Oh,
did.
someone else did it.
Don't give me credit for anything.
Get the folks in the
Jeez.
background getting it done.
That's right.
All
They've
right.
got us.
Cool.
All right.
Thank
Have
you,
a
sir.
fantastic weekend, Tony, as
You
well as
too,
everybody
man.
else. We'll see you on Monday.
All right. Peace out, man. What is going on, everybody? I'm on a different little time slot here. And I don't know if we have anything. Let's take a look at where we are though, because NQ just put in some new highs. This is a weak high in my world, by the way. We're going to go get that, in my opinion. We're going to go test 36. So we're going to go make a new high. Let's focus on that for 2 seconds here. And let's see if we can get into a trade. So I'm saying that kind of very matter-of-factly, only if this holds, by the way. So if the 800 holds, we have a really good shot by the end of the day of making a new high.